Welcome back to the deep dive. Tax season in the UK. You know what that means.
Oh, yeah. Everyone's looking for those clever ways to maybe shave a bit off their self-assessment, right?
Exactly. And that's what this deep dive is all about. We're going to dig into a blog post by MA&CO accountants.
Okay.
It was published January 21st, 2025, and it's called How to Reduce Your Self-Assessment Tax Bill. 8 Unique Tax Busting Tips.
8, huh? Sounds promising.
Yeah, and these aren't your typical, pension and ISA tips. We're talking about mileage claims for every company you work for.
Oh, interesting.
Transferring property ownership.
Without actually selling, right?
Yeah, without actually selling. And even potentially, get this, putting your kids on the payroll.
Wow. Okay, I'm intrigued.
So first up, mileage claims. We all know the basics, 45p per mile for the first 10,000 miles. Then it drops to 25p.
Right, standard stuff.
But here's the thing. You can claim this allowance for each company you work for, not just your total mileage.
Oh, really? So let's say I drive like 12,000 miles for one company and then another 8,000 for a second one.
Exactly. You hit that 10,000 mile mark for the first company, but you still get the full 45p rate for those first 10,000 miles with the second company.
Ah, clever. It's all about how you divide it up.
It's not about the total miles. It's about being strategic with those claims.
I like it. Maximizing every opportunity. And speaking of maximizing VAT-registered businesses, they can reclaim VAT on their fuel receipts too, right?
Yes.
That's an extra, what, like 7p to 24p per mile saved, depending on fuel costs?
Another hidden bonus.
Definitely emphasizes how important those records are. Every little bit helps.
Okay, tip number 2, gift aid. This one's about giving back and getting a little something back yourself.
Okay, I'm all for giving back, so tell me more.
So, say you donate £800 to a charity.
Right.
With gift aid, they can claim an extra 25% on top of that from the government. So that's another £200.
Right, so your donation goes even further.
Now, for higher rate taxpayers, it gets better. They can claim back even more on their tax returns.
So that £800 donation could actually only cost them, what, £600?
Exactly.
Not bad at all. Supporting causes you care about and getting a little tax relief in the process.
All right, tip number 3. This one might sound a bit complicated. Transferring rental property ownership.
Oh, okay. This is where it gets tricky.
But don't worry, we're not talking about selling your property. It's about transferring the beneficial interest to a spouse who's in a lower tax band.
So, like shifting the rental income so it gets taxed at a lower rate.
Exactly. Say your rental income is £12,000 a year. If you're in the 40% tax bracket, that's £4,800 in tax.
Ouch.
But if you transfer that beneficial interest to your spouse, let's say they're in the 20% bracket, the tax drops to £2,400.
Wow, that's a big difference.
A potential saving of £2,400 annually. And it doesn't affect capital gains tax if you decide to sell later on.
Okay, I'm seeing a theme here. It's all about smart planning, knowing the rules, and using them to your advantage.
Now, this next tip is especially for our self-employed listeners, especially those earning over £50,000. Have you considered a limited company structure?
Okay, so instead of paying personal income tax at those higher rates, you're going for corporation tax, which is currently at 25%. Big difference there.
Huge. And with a limited company, you can choose how to take your income. A mix of salary and dividends. Even more potential savings.
So if your profit is, say, £70,000 as a self-employed person in the 40% bracket, you'd be paying, what, £28,000 in tax?
Right. But with a limited company, you could potentially pay just £17,500 in corporation tax.
That's a whopping £10,500 saved. Makes you wonder why more people aren't doing this.
All right, get ready for this one. Employing family members.
Hold on, what?
I know it sounds a bit strange, but putting your spouse or kids on the payroll for legitimate business tasks, of course, can be a legitimate tax strategy.
So my wife helps with the admin. I pay her a salary, I reduce my profits, and she gets an income.
Exactly. And if your spouse doesn't have other income, they might even qualify for certain state benefits.
Interesting. But obviously, everything needs to be above board, right?
Absolutely. Market rate salaries, documented tasks. It's about fairness and following the rules.
Makes sense. What's next?
Okay, this one might sound too good to be true. Salary sacrifice.
Salary sacrifice. I've heard of it, but never really understood it.
It's a way to lower your taxable income by swapping some of your cash salary for non-cash benefits, like increasing your pension contributions, getting a company car, especially an electric one, or childcare vouchers.
So I choose perks over pounds, essentially.
Exactly. Let's say you earn £60,000 and decide to sacrifice £10,000 into your pension.
Okay.
Your taxable income drops to £50,000. You save 40% on income tax and 2% on national insurance for that £10,000. That's 4,200 pounds in savings.
Wow, that's a lot. And I've heard this can help avoid that child benefit tax trap too, right?
Absolutely.
It's all about being proactive, really exploring those options.
Now, tip number 7, claiming professional expenses.
Seems like an obvious one.
You'd be surprised how many people miss out on this.
Like, what kinds of things are we talking?
Membership fees, training courses, even work clothes or uniforms.
Really? So even those smaller things can add up.
Oh, yeah. There's a story in this blog post about a doctor who reclaimed 3,500 pounds. And you can backdate claims up to 4 years.
Now that's worth looking into.
All right, last tip for this part. Electric vehicle incentives. For our eco-conscious listeners,
Ah, this is a good one.
switching to an electric car can bring you some serious tax savings. The benefit in kind, BEAC tax rate, is just 2% on electric vehicles.
Compared to like 25% or even higher for traditional vehicles.
Exactly. And that low rate is in effect until 2025.
Even more reason to make the switch, especially if you combine it with, say, salary sacrifice.
So if you were to lease an electric car worth 40,000 pounds,
Your big tax would be just 800 pounds, and at a 40% tax rate, you're only paying 320 pounds in tax for the whole year. Amazing.
it's like saving money and helping the environment at the same time. Win-win.
Definitely. I love how these tax policies are actually encouraging people to make more sustainable choices.
So we've covered 8 really interesting tips, but we're just getting started. We'll be back to dig deeper into these strategies and see how they fit into your overall financial well-being.
Sounds good. Looking forward to it.
Welcome back to the Deep Dive. We've uncovered 8 unique tax-saving tips, and now it's time to go beyond the how-to and really explore the why.
Yeah, I think it's fascinating how many of these tips actually connect to like bigger financial planning ideas, like take the limited company structure.
Right. That one really stood out to me, especially for higher earners.
It goes beyond those immediate tax savings. It's a decision that could affect, your long-term wealth building strategy.
So it's like choosing the right, vehicle for your income, one that can really take you further toward your financial goals.
Precisely. It influences investment opportunities, retirement planning, even how you might pass on wealth to future generations.
Wow, that has a whole other layer to consider.
And it really emphasizes, I think, the need to get personalized advice, from a tax professional. These tips are great starting points, but everyone's situation is different.
I completely agree with that.
Yeah.
Now let's go back to tip number 3, transferring rental property ownership. You called it the tax tango, right?
Yeah. It's a neat strategy, but I can see how the legal side might seem a bit daunting for some people.
Definitely. Deed of trust, Form 17. It can sound a bit intimidating if you're not familiar with all that.
Right. So for anyone thinking about this, clarity is key. First, at those open conversations with your spouse about shared financial goals and how this transfer fits into your overall strategy.
It's a joint decision, not just a solo tax move.
Exactly. And secondly, professional guidance. A solicitor to make sure that deed of trust is done right,
Yeah.
a tax advisor to help with the HMRC requirements.
Don't try to DIY this one. Expert support can make all the difference.
And speaking of experts, tip number 7, claiming those professional expenses, really highlights the need for, meticulous record keeping.
Yeah, that doctor who reclaimed 3,500 pounds, that was eye-opening.
It really is. Shows how those seemingly small expenses add up. But without proper documentation, you could be missing out.
So what's your top tip for staying organized? For making sure those deductions don't slip through the cracks?
Technology. There are some brilliant apps and software out there specifically for expense tracking. They're lifesavers, especially if you've got multiple income streams or a lot of expenses.
Some of them connect right to your bank account. Super easy to categorize everything.
Exactly. Makes tax time way less stressful, and you're more likely to claim everything you're entitled to.
Okay, a little tech savvy goes a long way in maximizing those deductions.
Now, let's talk about a tip that's, close to my heart. Those electric vehicle incentives.
Financial savvy meets environmental consciousness.
Right. What I find so exciting is how tax policy is being used to encourage sustainable choices.
It's like a gentle nudge in the right direction for your wallet and the planet.
And as we move toward a greener future, these incentives are probably going to keep evolving. So staying up to date on those changes in policy is key.
It's not just about today's savings. It's about being ready for future trends.
This whole deep dive is about that, being proactive, not reactive.
Okay, let's circle back to employing family members. I'm sure some listeners are wondering about the ethical side of things.
It's a valid point. Transparency and fairness are essential. It's not about, giving your 10-year-old a made-up job just to lower your tax bill.
Right, no junior vice president titles for the kids just yet.
Exactly. It's about recognizing legitimate contributions, like if they're genuinely helping with the business and compensating them fairly, just like any other employee.
So clear expectations, documented tasks, market rate salaries, no shortcuts.
Absolutely. Keeping everything above board beneficial for both the business and the family member.
Now, before we wrap up, let's revisit the gift aid strategy. I think it's such a powerful way to use our tax choices for good.
I agree. It really shows how financial decisions can reflect our values.
Instead of just trying to minimize our tax, we can actively use it to support causes we care about.
It's a mindset shift, isn't it? From how much can I save to how can my money make a difference?
It turns tax planning from a chore into an opportunity to align our finances with our passions.
Less about saving money and more about investing in what matters.
Now, before we move on, I want to touch on something we haven't explicitly addressed: risk.
Yes. Risk. A constant companion on any financial journey.
It's easy to get excited about potential savings and overlook the potential downsides.
Right. Every financial strategy, including these tax-saving tips, comes with its own risks.
So how do we find that balance between maximizing gains and, minimizing those potential losses?
Diversification is key. Don't put all your eggs in one basket.
So spread the risk, explore different asset classes, tailor your approach to your own risk tolerance.
Exactly. And remember, there's no one-size-fits-all solution in finance.
It's a very personal journey.
Understanding your circumstances, your goals, your values.
And making informed choices that feel right for you.
Speaking of informed choices, let's touch on salary sacrifice again.
Right, where you swap that cash for those attractive non-cash benefits.
It can lead to big tax savings, but you need to weigh the potential trade-offs. You're giving up some immediate liquidity for future gains.
And those future gains might not always align with your needs. Things change unexpectedly.
Exactly. And depending on the benefit, there might be restrictions, like those electric car incentives are great, but what if your driving needs change later?
Good point. It's about long-term thinking.
Flexibility is crucial in financial planning. Life throws those curveballs.
Before we move on to our final thoughts, let's revisit a theme that's been woven throughout this conversation: seeking professional guidance.
Yeah, it's a golden thread connecting all these strategies.
The tax system can be so complex, going it alone can be overwhelming.
And potentially lead to costly mistakes. A good tax advisor can tailor these strategies to your situation, make sure you're compliant with HMRC, and help you really maximize your savings.
It's peace of mind, priceless when it comes to your finances.
Absolutely. Don't hesitate to get that professional help.
It's a sign of being financially savvy, not weakness. Now, as we head to the final part of our deep dive, let's zoom out a little. Bigger picture.
Beyond individual strategies, what are the key takeaways?
What are those guiding principles for making those informed decisions?
Those are great questions, and it brings us to the core of what we're trying to do here on the deep dive.
It's about empowering you, our listeners, to be more conscious, more intentional, and ultimately more in control of your financial lives.
Moving beyond just managing money to actively shaping your financial future.
And that journey begins with knowledge.
Equipping yourself with the right information gives you the confidence to navigate the financial world.
And to make those choices that truly align with your values, your goals, your aspirations.
Speaking of aspirations, let's go back to those electric vehicle incentives.
The ones that sparked those conversations about sustainability and aligning our financial choices with our values.
It's such a great example of how everyday decisions like choosing a car can have a bigger impact.
Our financial choices have implications beyond ourselves.
They affect the environment, our communities, future generations.
It's about embracing a more holistic view of wealth.
One that encompasses financial, social, and environmental well-being.
So it's not just accumulating wealth. It's about how we use that wealth to create positive change.
Exactly. And that brings us to a really fundamental question. What is the purpose of money?
Is it just a means to an end? Or a tool to create a life of meaning and impact?
It's a question worth pondering. We each need to find our own answer.
But by engaging in these conversations, by exploring these ideas, we can start to shift our relationship with money.
From fear and scarcity to empowerment and possibility.
It's not just about saving money. It's about investing in a future that reflects our deepest values.
And that, I believe, is the true essence of financial literacy.
Welcome back to the Deep Dive. We've explored these 8 pretty unusual tax-saving tips, looked at the nuances, and even thought about the bigger meaning of money. So now let's bring it all together.
Yeah, it's been a fascinating deep dive, really uncovering those hidden gems within the UK tax system.
It really has. So as we wrap this up, I want to leave our listeners with something valuable, a challenge,
Get
actually.
it, challenge. I like it. Lay it on me.
All right. So instead of just minimizing our tax bills, what if we focused on like maximizing the positive impact of our financial choices?
Ooh, okay. That's a different way of looking at it. Using these strategies not just for ourselves, but as a way to do some good in the world.
Exactly. So here's the challenge. Take any of the tips we talked about, whichever one resonated with you the most,
Right.
and think about how you could use it not just to save money, but to, actually make a difference.
So, for example, those electric vehicle incentives. Switching to an electric car, that could be about more than just lower taxes. It could be a statement about your commitment to, a greener future.
Perfect example. Or maybe it was gift day that really got you thinking.
Hmm.
Could you increase your charitable giving knowing you're maximizing the impact and getting that tax relief too?
It's like taking tax planning and moving it beyond just numbers, making it about your values, your vision for a better world.
And that's where it gets exciting. When we connect our finances with our passions, our purpose.
It becomes less about saving, more about investing in what truly matters.
So as we conclude this deep dive, I urge you to take on this challenge. Don't just settle for a lower tax bill.
Aim higher.
Maximize your impact on the world. Use these tips as like stepping stones towards a more fulfilling, a more impactful financial journey.
And remember, knowledge is power. The more you know about your finances, the more control you have over your financial future.
And the more you can create a life that really reflects what's important to you. So thank you for joining us on this deep dive into the world of tax-saving strategies.
We hope you've learned something valuable, maybe even feel inspired to take action.
And remember, the journey doesn't end here. Keep exploring, keep learning, and keep striving to make a difference.
Until next time, happy saving and impactful investing.